the last lesson is about the best companies to buy, and you want to listen to that, man, because the best companies to buy are super key. Warren Buffett gives you the secret on the best asset to hold. Hello, everyone. Welcome to Just Invest Today. And today we're talking about the Warren Buffett shareholder letter of 2020, 2021. Because remember, the next shareholder letter is coming up soon. So we should go back into 2020, talk about the lessons that we learned from that year and what he saw at Berkshire, and just get a view of what he saw, how we can become better investors, and the lessons that we learned from just reading this letter. Because there's so many gems. There are hidden gems all over this letter. People forgot about it, but I'm going back to tell you about it. So guys, please like this video, subscribe to my channel, man. Subscribe down below, man. I'm on my road to 1,000 subscribers. Can you please help me out? It'd be greatly appreciated. So this is Warren Buffett's letter to the shareholders. He does this every year. You have to read all of them. They're amazing. I'm even going back and read them over like 3-4 times. So let's get into it. The first gem we can take away from this letter is basically being patient and waiting for the perfect opportunities and just taking accountability. Our focus at Berkshire is both to increase the segment of our income and to acquire large and favorable situated businesses. Last year, however, we met neither goal. Berkshire made no sizable acquisitions and operating earnings fell 9%. Valued by both retaining earnings and repurchasing about 5% of our shares. So they repurchased their shares, they retained their earnings, but they made no acquisitions. And that's Berkshire's goal, right? To make these big acquisitions. But in his mind, he was just being really, really patient. You could see that as a mistake. Maybe it wasn't. But remember, they have a lot of money on their books and they have to protect the company because remember, there was a pandemic and a lot of their businesses did get hurt. So he was just being super patient, man, and just waiting for the perfect opportunity. Even though he didn't buy, you understand Buffett's mindset and how he thinks about just waiting for that perfect pitch to hit out of the park. And that is critical. And then the second lesson, he's taking full accountability of his mistakes. In the final component of our gap figure, the ugly $11 billion write-down is almost entirely the quantification of a mistake I made in 2016. That year, Berkshire purchased Precision Cast parts, and I paid too much for the company. No one misled me in any way. I simply was too optimistic about PCC's normalized profit potential. And how many people do you think are making that mistake? We just have this view of a company that is just going to keep generating all this cash in the future, and we just pay a crazy price for it, not realizing the future is so unpredictable and sometimes you can't predict it. And that's the mistake Warren Buffett made, man. He wasn't patient enough. He overestimated the projections of the company's profit, so he had a $11 billion write-down. This goes to show you that actually waiting for the perfect price and paying a good amount for a business is actually crucial for your investment decisions. So those are two gems right there. So we're going to the next gem that I saw reading this letter. The next two lessons have to deal with trust and opportunity. Look at the opportunity that Warren Buffett saw in the market. Last year, we demonstrated our enthusiasm for Berkshire's spread of properties by repurchasing the equivalent of 80,000 A shares and spending $24 billion in the process. This action increased our ownership in all of our Berkshire businesses by 5.2% without requiring you to do much as touch your wallet. So comes down to it. When there's nothing you see, sometimes the best businesses are actually already in your portfolio. The ones that you know and the ones that you actually understand the value. Sometimes you don't always have to just look somewhere else to find companies. Compare the companies in your portfolio to the companies outside of it, the ones that you want to purchase. Look in your portfolio right now. See if there's any strong companies that are still undervalued you can probably purchase more of instead of buying something else that you don't know of. And that's exactly what Warren Buffett did. He's repurchasing shares of his own company because he thinks it's undervalued. And that's where he sees the opportunity. So sometimes people make the mistake of just looking somewhere else to buy something that they don't really know a lot of, or it's not meeting their price recommendations, but they're still going to buy it, even though there's something in their portfolio right now that's cheaper, that you understand, and you think it's undervalued. So just do that exercise anytime you're about to purchase a new stock. Is look in your portfolio. Is that stock better than what you actually have in there? If it's not, then why are you buying something else? And that's exactly what Warren Buffett did. He's repurchasing his own shares because there's nothing out there that's better than his own stock. So that's another good example of how Warren Buffett thinks. This is how I think trust is super important in your investment decisions. Charlie formed his partnership in 1962 and operated much as I did. Neither of us had any institutional investors, and very few of our partners were financially sophisticated. So that just goes to show you that you can start your investment journey without anyone backing you or with any institutional backing. The people who joined our ventures simply trusted us to treat their money as we treated our own. These individuals, either intuitively or by relying on the advice of their friends, correctly concluded that Charlie and I had an extreme aversion to permanent loss of capital and that we would not have accepted their money unless we expected to do reasonably well with it. And this is what I want to say. The people who trusted them knew that Warren Buffett and Charlie Munger had an extreme aversion to permanent loss of capital. And that's the way we gotta think. When we are investing our own money, sometimes we don't really think hard on it because it's our own money. But when you think about it, think about having your parents' money, your grandfather's money, your grandma or your friend's money. You are going to invest differently. I promise you. If it's not your own money, if you think about everyone else's money, you are going to invest super differently. You're going to take your time on investments. You're going to make sure everything is proper. The trust is there with the companies, with the managers, making sure the company has a moat, is economically strong and advancing. You are going to do that because you just don't want that risk of losing other people's money. So have that in mind, that trust factor, that people would trust you with their money, and that's how you want to invest. You want to make sure all your best investments, the downside is protected. You got to make sure the downside is protected. The upside will take care of itself. And that's what Warren Buffett always says. Time is the friend of a wonderful business, the enemy of a bad business. And that's how we got to look up our purchases and our investments. The next two lessons talk about family and how just the ownership mindset when you're investing is super key. Because when it's the ownership mindset, you're going to want to last in that company. And then the last lesson is about the best companies to buy. And you want to listen to that, man, because the best companies to buy are super key. Warren Buffett gives you the secret on the best asset to hold. So let's read this part. Berkshire's unusual and valued family of individual shareholders may add to your understanding of our reluctance to court Wall Street analysts and institutional investors. We already have the investors we want and don't think that they on balance would be upgraded by replacements. There are only so many seats, that is shares outstanding, available for Berkshire's ownership, and we very much like the people already occupying them. Of course, some investor turnover in partners will occur. Charlie and I hope, however, that it will be minimal, and after all, seeks rapid turnover in friends, neighbors, or marriage. So that's how Warren Buffett looks at his shareholders. They're basically looking at them as families. His shares are outstanding, are there's so many seats that Berkshire holds, and he wants people just to stay in those seats. Don't move. Hold this Berkshire company for the long term. And that's how we gotta view the investments that we make. Like investments like Baba or Google or Facebook. We just want to hold them. Depending on the situation, sometimes you want to get rid of them if something comes up, if your thesis changed. But if it doesn't, you want to treat these companies like the ownership that they are and that you want them to be, man. You want to think of it as like Bill Gates owning Microsoft for all those years, or like Jeff Bezos owning Amazon for all those years. So that's the mindset that he's trying to get you in. The tens of millions of other investors and speculators in the United States elsewhere have a wide variety of equity choices to fit their taste. And he's calling everyone out, saying all these gamblers in the market are just in and out of all of these equities, and we don't want that for people who want to own Berkshire. They will find CEOs and market gurus with enticing ideas. If they want price targets, manager earnings, and stories, they will not lack suitors. Technicians will confidently instruct them as to what some wiggles of the chart portend for the stock's move. This calls for action will never stop. Many of the investors I should add, will do quite well. After all, ownership of stocks is very much a positive sum game. Indeed, a patient level-headed monkey who constructs a portfolio by throwing 50 darts at a broad listing of all the S&P 500 will over time enjoy dividends, capital gains, just as long as it never gets tempted to make changes in the original selections. Productive assets such as farms, real estate, and yes, businesses ownership produce wealth. Lots of it. Lots of it. Most owners of such properties will be rewarded. All that is required is the passage of time, an inner calm, and an ample diversification and minimization of transaction fees. So, guys, can you really do that? You need an inner calm, ample diversification, and minimization of transaction fees. It's that simple. Once you're owning a farm, once you're owning a rental property, you don't care what happens or all the talk of speculation of interest rates, all of that stuff. It doesn't matter. You're just going to own it forever for 5 to 10, 15 years, whatever it is, because you know it's an amazing company. And this is the nail in the coffin. This is the perfect asset to buy. I love what he said. Our leadership in fixed asset ownership, I should add, does not in itself signal an investment triumph. The best results occur at companies that require minimal assets to conduct high margin businesses and offer goods for services that will expand their sales volume with only minor needs of additional capital. We in fact own a few of these exceptional businesses, but they are relatively small and at best grow slowly. So that's the best asset to hold. When you're looking at assets, try to find these companies. You can find companies that have a lot of assets, heavy assets, a lot of capital expenditure, and still grow fast, but we want the best companies, and the best companies require minimal assets with high margins. High margins is like 50-60%, and we can think about Google, Facebook, Alibaba. You think of those companies, they don't really have a lot of assets. They just have just all these services and like goods that they offer you, but it's not a lot of assets, like structures compared to Amazon with a lot of structures, a lot of inventory, all of that. Offer goods or services that will expand their sales. Are these businesses growing their sales and volume of goods and services? You have to look at that with minor needs of additional capital. So you don't have to keep investing all of this money, all this heavy load into the business to keep it growing. Think about railroads, or think about like type of companies like that, or like the airlines. You have to keep updating. You have to keep investing more and more on new airlines, on new freaking planes, on gas, all of that stuff, and it all kills the earnings of the company, man. So those are the best assets to hold if you can buy those companies, man. So that's it for the shareholder letting, man. Tell me what you think about it. I thought there was so many gems in it. I'm going to read the next letter when it comes out. There's going to be even more gems, and his thinking is always amazing. So tell me what you think about this video. Like, subscribe, and comment down below, man. Thank you. Peace.